All right, hey guys, in this video, we are going to look at part 5 of our 5-part series. And so far in this series, we've looked at situations where cash and economic activity, either classified as economic value created or consumed, happens at different times. But as I've mentioned and primed you for in this video, what happens if no cash happens at all? So let's say that you buy something once, and then year after year, you still need to record the economic value that you've been consuming. Even though no money is leaving your account, you still need to keep track of this change in economic value. That's where the concept of depreciation comes in. So let's first start by defining what depreciation is. And let's say that you buy a car for $30,000. You expect to use that car for 5 years, and at the end, you think it'll be worth, say, $5,000. Here's the key idea. Depreciation is the process of allocating that cost of the asset, in this case, the car, over the period it is used. Okay. It's not a cash flow. It's not based on market value. It's just a systematic allocation of cost over time or usage. So there are two ways to allocate this cost that I will deal with in this video, but just know that there are many different methods that you can use to allocate cost. And those are topics for more advanced accounting courses. So the two intuitive ways that you can do this is one, over time, and this is called the straight line method, okay? The second way that you can allocate this cost based on your usage is called the units of production. And if we're talking about a car, then we're looking at the kilometers that are driven. So let's walk through this. And what I'm going to do is I'm going to introduce you to the depreciation schedule, which is simply a table that we use to keep track of all of the different moving parts. Okay, so to do this, we're going to open up Excel, and I'm going to share that with you now. So what you can see is our depreciation inputs tab. And then I'm going to go through both the straight line depreciation schedule creation and the units of production or units of usage depreciation schedule as we're talking about a car in kilometers. So we'll do each one of these in turn. First, we're going to start with our straight line depreciation method. Okay, so we need a couple of pieces of information. We need the initial cost of the particular asset, and that's going to be our $30,000. Okay, and if you want to format the currency or whatever, you can do that. We said that the salvage value, or the value that's going to be remaining after we've used it, is going to be still $5,000. Okay. The depreciation base is calculated as the difference between the cost and the salvage value. So we just take the 30,000 minus the 5, and that gives us a $25,000 depreciation base. The useful life can be calculated as the the useful life can be calculated as the number of years. So in this case, we're going to say 5 years times the numbers of months per year, 12. So we've got 5 times 12, and that gives us 60. Okay, so these are the necessary inputs for us to be able to create our depreciation schedule. So our beginning value, we just want to link this one to that input of cost. Okay, and next we want to deal with the depreciation expense. When we're looking at straight line, we're just allocating this $30,000 and actually minus the salvage value, so the 25,000, over the life of the asset. So the way that we calculate this is we take our depreciation base and we divide it by the number of months that we have. Okay, so in this case, the depreciation expense is $416.67. Now, we want to keep track of the accumulated depreciation. So how much depreciation has accumulated over the life of this asset. Okay, and this becomes important for future reference when we're creating our net worth statement. So for now, this value is simply equal to the depreciation expense. What's the ending value after month one? Well, it's going to be our beginning value minus the depreciation expense. Okay, now that becomes our beginning value of month two. Our depreciation expense is actually going to be the same because it's a straight line method that we're using. So let's anchor the column and the row of both inputs on our depreciation inputs tab. And that way we can just drag this down to get our next value. The accumulated depreciation, we actually have to make an adjustment here because it's going to be the amount from the prior period plus the depreciation expense in the current period. Okay, so the total now is 833. We can just drag this one down because we're just taking the beginning value minus the depreciation expense to get our ending value. So now this row is in a format that we can use to just drag it down. Let's just do one to make sure that all of the math lines up the way that we want it to. Okay, and so yes, we start here, the 416, it changes. This value is pulled from here, so that looks good. And 833 plus 416.67 is equal to the 1250. That's good, and our ending value looks good as well. So now we can drag this, and what we should see is that the ending value after this depreciation expense has been applied over the 60 months or the 5 years, the ending value should be 5,000 if we did it right. So let's drag this all the way down to month 60. And in fact, we do have the 5,000. And what does that 5,000 represent? That's the value after the 60 months or the 5 years that the asset is worth. That's the salvage value. Okay, so that is how you create this depreciation schedule for straight line. Now we want to move on to the units of production or units of usage method. In this case, we still have the same $30,000 asset. The salvage value is still 5,000. And the depreciation base is the difference between the two. Now we need an estimate for the total expected usage. So for this particular car, we're going to take a look at, say, 200,000 kilometers, okay? This can be estimated. Obviously, if you estimate that the expected usage is going to be longer than this, than like say 300,000, then what that's going to do is it's going to generate a lower cost per unit. But you want to be as accurate with your estimate as possible, okay? So now we need the cost per unit, and the way that we get that cost per unit, which is the cost per kilometer, is we take the 25,000 and we divide it by the 200,000 kilometers, and that gives us let's just add one more decimal place, 0.125. So in other words, 12.5 cents for every kilometer driven with this car. This represents the wear and tear of the vehicle. So let's now create the amortization or the depreciation schedule here. And in order to do this, we have to have the actual kilometers driven during the month. So record keeping wise, this would be a little bit more cumbersome because you have to, at the end of every month, you have to remember how many kilometers have I put on the car. Now, you can just take a look at what the odometer says and you can say, okay, it's this now, it was whatever the last time, and the difference tells you how much you drove. All right, so the beginning value that we want to put in here is going to be the same beginning value as before. So we just got the cost here. So we got to press equals, go to the units of production method, grab our 30,000, and that's good. To calculate our depreciation expense, we're going to need the total kilometers driven multiplied by our cost per unit. And that's going to give us 416.67. The accumulated depreciation is just going to be that amount. And the ending value is going to be the beginning value minus the depreciation expense. Don't use the accumulated depreciation value, okay? So then we take the beginning value as the ending value. We have the depreciation expense is going to be the same, but we have to anchor the rate. Okay, so don't forget to do that. And then we can just drag this down. We'll see here that our accumulated depreciation updates, and that's because it's equal to the line above plus, okay, so the already existing accumulated depreciation from the last period plus the new depreciation expense. That gives us 833. And we can see now that the ending value is just the beginning value minus this new depreciation expense equal to that, okay? Now, it's very important. We can drag these down. Don't touch anything related to the kilometers driven. In the real world, you would enter the kilometers driven one by one because you wouldn't have the same amount every single time. But in this, I've already populated it with an estimate of what these kilometers driven are going to be. So now I can drag this all the way down to month 60. Okay, I skip over this one and I can highlight these three and I can drag this down. And if I've done this right, if I've programmed everything correctly, then this bottom cell should also equal 5,000, which it does. Okay, so this is the economic value that's been consumed, depreciation expense. And we have to make sure that we include this. You know, the economic value of your vehicle, it doesn't stay at what you purchased it at. It declines over time. Now, straight line depreciation, does that represent reality? No, not in the case of cars. When you buy it, as soon as you drive off the lot in that month one, your depreciation expense is quite significant. From there, each car sort of follows its own behavior of what the actual depreciation expense is compared to, you know, what we think it's going to be, which is what we're trying to predict with these different types of models. So we've just looked at these two. Again, there are many other depreciation valuation models that are out there, but for simplicity, we're just trying to estimate exactly what the loss in our economic value, our net worth ultimately, is going to be on a month-by-month basis. So with the straight line, we're just using an even amount over time. For the units of production, we're basing it on usage. In both cases, the total depreciation at the end of the period of time is the 25,000, and in both cases, the ending value is 5,000. The only difference is when the expense is recognized, and that's what this entire series is all about. Timing differences. Okay. When is the economic value being created or consumed? In the case of no cash, it's consumed. And uh, when is the cash flow realized? So, as a final takeaway, depreciation is one of the clearest examples of an expense, okay, economic value being consumed with no cash flow and tracked over time through accumulated depreciation. It shows how financial systems capture economic reality, not just cash movements. And the nice thing is that this doesn't just apply to cars. Other assets that are depreciated include equipment or machinery that you may have, buildings, if those buildings depreciate over time, technology. And for intangible assets, we use a similar concept called amortization. So even when no cash is moving, value is still being used, and depreciation is how we track it. If this has increased your understanding on economic value and your finances and your financial well-being, make sure you hit like, subscribe, and get notifications for when I create new content.